Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me, Sumera Abdi and Pavitra Pari. Good morning, girls. Brand new week, a packed one at that. So many earnings to track. And I know I've been saying that watch for IT. But this week, we also get numbers in from Bajaj Auto, Shree Cement. So a sneak peek into other earnings. And on Saturday, we've got HDFC Bank as well. So even a glimpse of banking indicators before the close of this week and the start of the next week. In terms of our markets, we are reacting to the big sell-off that we had on Wall Street on Friday, where the key indices were down close to about 3%. We had a weak start, and we continue to trade with cuts of in excess of more than 1% on the benchmark indices. The Nifty for now is holding above that 17,100 mark, but this is after a nasty 200-point fall on the Nifty and nearly 665 points gone on the Sensex. The advanced decline ratio is weak. The mid-caps are bleeding. The advanced decline ratio stands at about 2 stocks in the green for 5 in the red. There is no Nifty index, which is currently in the green. So all the Nifty, most of the Nifty stocks are currently under pressure. This is a fairly broad-based sell-off. And in terms of the Nifty stocks, which are managing to hold up in the green, well, just 3 of them. So that gives you an indication of the weakness of this market. We've got Axis Bank up 1%, Power Grid up 0.6%, and TCS, which is holding up in the green by just a sliver, up 0.1, 0.2%. The rest, 47 out of the 50 stocks are under pressure, with the big loss coming through on Tata Motors. JLR numbers, not good.
Well, absolutely. Like you said, this is a broad-based sell-off, but a lot of the pain in the auto pack today and also the FMCG, like we saw last week as well. So for the auto pack, you have Tata Motors as well as Hero, which are seeing some sharp cuts. These are some of the biggest losers on the Nifty. Some of the FMCG names will also come up for you. The likes of Tata Consumer, HUL seeing losses of over 2%. So do keep that entire pack on your radar. In fact, if you take a look at the last 5 days, a lot of these consumer companies have seen sharp cuts. So something like a Godrej Consumer is down over 10%. You have Tata Consumer, which is down 4%, HUL around 5.5%. So that's the kind of cut that we've seen on some of the larger FMCG names. So watch out for that. There are a lot of cues that we need to track. First up, like Reema mentioned, the ITE earnings start today. The 4 big companies will post earnings this week, so watch out for that entire pack. You have the rupee, which has seen a sharp move. It's currently at around 82.4, so it's come off a little bit, but that's something that we're tracking. Crude has seen a sharp up move, around 18% in just 1 week, and it's currently at around 98. And now, with the jobs data out of the way, the next big important global cue to track will be the inflation data coming out of the US on Thursday. So we have a lot for us to track. Sumera, we have started off on the back foot, but let's see how we go from here.
All right, so let's get started. We have a lot lined up, so we'll tell you all that you can find out in the next 1 hour. Market is deep in the red, though, off the opening lows. All sectoral indices declined, led by weakness in FMCG, auto and pharma names. To talk about the outlook for the equity space on the road ahead, we'll be joined by Varun Lochab of HDFC Securities.
The rupee hits a fresh low of 82.62 to the dollar. We get you more details on the factors leading the currency lower a little bit later on the show.
Latest from the primary market, the IPO of Traxon Technologies opens for subscription today. We'll catch up to speed with all that we need to know about the offering and also get chatting with the management in just a short while from now.
And finally, individual names like Tata Motors, Atul Auto and Bandhan Bank are all moving around on the back of news flow. More details on that in just a bit. So all of this and lots more lined up for you over the next 60 minutes.
But let's kickstart Trading Hour by putting the spotlight on the new kid on the block. The IPO of Traxon Technology opens today. So just a quick word about the company. Now, if you want to make an investment into a listed stock market, all the details are available. You know their quarterly numbers, you know all the key indicators, the key metrics, the KPIs that the company reports every quarter. But if a VC company or a private equity company wants to make an investment into another private company, the details are not available. So this company, Traxon Technology, provides market intelligence data for private companies. And this it will provide to its customers on a subscription basis. Now, if a private equity investor wants to, say, make an investment into an edtech company, what will he need to know? He will need to know some M&A targets. He will need some deal diligence analysis. He may also want to know what the competitive landscape is looking like. So who its competitors would be, what would their market share look like, not just in India, but even globally. Or even if a private equity investor or a VC throws a question that tell me which are the emerging market themes across industries, all that data for private companies is provided by Traxon Technology. Now, about the issue per se, it's looking to raise about 300 crore rupees, but this is a pure offer for sale. there is no fresh money that the company is raising. This 309 crore, which is the IPO size, it will be raised by the promoters and some of the key investors like the Flipkart, founding family, Axel Investment, Axel Partners. They will be selling their stake. 300 crore post issue. Once it's listed, its market capitalization will be close to about 800 crore rupees. Neha Singh, the chairman and managing director of the company, now joins us on the show. Neha, thank you very much for that. First question, why is the promoter and why are some of your old investors selling, in the IPO right now? What's the rationale? And do you not need any fresh money? Could you tell us the reason why the company has not opted for raising fresh money? What's the cash that you have on your books?
Thanks, Rima, firstly for having me. If you look at the financials of the company, we have last quarter was profitable. We did a positive PAT of 4.5%. Also, the other thing that you can see is that there has been a non-linear EBITDA expansion across all these years. So just last year, for instance, 78% of the incremental revenue that we added went directly into the bottom line. Right? In addition to that, the company has also been generating free cash flow, which has been increasing across the years. Like last financial year, excluding the IPO expense, which is reimbursable to the company generated 5 crore of free cash flow, whose run rate has increased to 5.8 crores in the first quarter of this financial year. And for the same reason, though we tend to be very aggressive in terms of the growth, a lot of the future growth has been able to finance with the cash flows that the company generates. Right? And that is the reason why the offer is OFS, because if you raise primary, you have to expense it in the next 1 to 2 years as per regulations. And the business also is not a very heavy capex requirement that you need for the growth of the company. So we are able to sustain a lot of the future growth through the increasing cash flow of the company. That is also, I think the office is also testimony to the fact of the sort of business model of the company.
All right. Hi, Neha. Good morning, and thanks for joining us. This is Pavitra. So you're saying that there's no real need for you to raise money. We take that point. Can you also, take us through, like Rima was pointing out, why are you looking to sell this? Why are the promoters looking to sell this stake in the company? That's one. And also, like you pointed out yourself, the company has just turned profitable last quarter. So wouldn't it be advisable to wait for a few quarters and then, come forth with an IPO, or why so soon?
Right. So in terms of the holding, so the promoters will continue to be a larger shareholder. So we'll continue to own more than 35% even post IPO. Also the investors who had invested in the company when the company was private will continue to own 26% of the cap table on the post IPO basis, which includes investors like Mr. Ratan Tata, Seabright, Venus, who will continue to hold on to their investment. On the second part, which is what you mentioned, that yes, we have turned profitable, but if you look at the trajectory of the company, that has been fairly linear. So if you look at the EBITDA expansion across the last 4 years, that has been fairly linear. For instance, in the last 3 years, our revenue has increased at 30% CAGR, while the cost has only increased at 4%. Also, the other interesting thing is that because we do prepaid collection for the entire subscription period, the company has been cash flow positive for the last 1.5 years. And that has also been increasing. So if you look at just the last 12 months, we increased the team size by more than 150 people, primarily adding people in the sales and marketing functions. But all the growth that the company has been doing, the free cash flow that the company generates has been able to finance that. And I think the other interesting aspect about our business is that we also enjoy the cost arbitrage. So we make in India. So all our team is based out of India, but we actually sell globally. So 70% of our revenue is international, primarily USD. So through that, we also enjoy a long-lasting sort of cost arbitrage which exists.
Okay. Hi, Neha. Morning. So until last year was the first year that you have made a profit, right? But the way we understand is that, incrementally, you don't need to keep adding capex. Your highest cost would probably be your wage bill or marketing expenses. So what is the reason that for, the years before that, you were making losses in the region of 400 to 500 crores?
Yeah. So if you look at our business, we are a global private market intelligence platform. For the first 5 years of the business, you have to invest a lot in building the technology platform and building the data, right? Which is the reason why we had also raised venture capital funding of 113 crores from various private market investors as well as angel investors like Mr. Tata, Nandan Nilekani, founders of Flipkart, Delivery, etc. Right. And so the first 5 years, I would say, was in building the technology, the data platforms. We work with customers globally. So we work with private market investors, large corporates across 50 different countries. Right? If you look at in the last couple of years, most of the incremental expansion and the growth has gone in the sales and marketing functions. For instance, last year, when we increased the headcount by 150 people, bulk of the team size got added in the sales team. We also have a very interesting sales model. Like our sales team is actually based out of India, but they sell to customers globally. So they work across all the time zones, working with investors across Japan, Europe, North America, etc.
Okay. Also, by the way, I erroneously mentioned that your loss is 400-500 crores. I meant 4 to 5 crores. Subtract the zeros from there. My apologies. Neha, now that you're saying that last year 70% of your revenue has flown directly to the bottom line, can you help us in terms of what is the trend that you're seeing in terms of your margins, etc.? What is the headroom that you have for expansion?
Yeah, so that is a very interesting aspect about the business. Even if you look at companies which are selling data to public market investors, these are fairly cash-rich companies, right? Because once you have built the initial investment in building the data and the technology platform, the cost to serve incremental customer is very minimal, right? And that is why if you look at, we have had a non-linear EBITDA expansion across the last 4 years, which has been sort of fairly consistent across all the years, right? And we hope to sort of continue to building on this trajectory of EBITDA expansion as well as free cash flow expansion.
So what would your gross margins be right now, Neha?
So we haven't given the gross margins in the prospectus, but it is fairly high. Even if you look at the public market data companies, their margins are fairly high. And a good proxy of that is how much, if you look at our revenue and the expense trend, like the last 3 years, our revenue increased at 30%, while the cost only increased at 4%. So we are able to serve a lot more incremental customer base by not increasing a lot of costs.
But can you give us an approximate range of gross margins, and can it expand from here on?
Yeah, so it is fairly high. Like I was saying, a good proxy is 78% of our incremental revenue, which we added last financial year, actually went into the directly into the bottom line, right? So you can expect sort of that profile of the company to continue.
Okay, Neha, just one final question. The total addressable market is expected to grow around 12%. That's what we gather. Can you tell us, do you expect to outperform the industry?
So currently the market is fairly deep. Just in terms of numbers, the private market asset under management crossed $9 trillion last year. If you just look at 2021, VCs and PEs invested more than $1 trillion across private companies globally. And currently we are actually at less than 2% of the overall addressable market. So we see a lot of room to grow and, sort of decades worth of growth in front in this market.
You're saying that you are right now able to cater to only 2% of the addressable market?
Yes.
Okay.
That's correct.
Okay, so then as you need to expand your database, include the repository of companies, will you not need to make substantial investments? And will that not hurt your margins? Because the whole, the reason you said that the company was loss-making in the prior years, because you were building that database, you needed to make those investments. But as you make the investments so that you can expand your addressable market share, will it not continue to keep your margins depressed?
So interestingly, what happens is that the initial 5 or 6 years, you spend a lot in building the technology infrastructure, building an analyst team, building a data operations team and processes, which is what we had done in the journey of the company, right? Like if you look at it, we today have 800 people team, which is based out of India, which has a large team of sector focus analyst team, a 80-member technology and product team, as well as a large data operations team. So the first 5 years of starting the company, you have done a bulk of the investment in these functions. In the subsequent year, you can actually leverage your investment in this in the data that you've built by selling to additional customers. So that is why you've seen actually the profile increase, becoming better. Your profitability actually has actually become better over the last 3 years in a fairly linear manner.
Okay, Neha, we'll leave it at that. Thank you very much for joining in and wish you all the very best and look forward to more interactions with you. That's Traxon Technology, the new kid on the block. Slip into a very short break on that note. On the other side, we'll come back and talk commodities. Manisha Gupta joins in as always.
Hi, welcome back. You're watching Trading Hour. Let's focus now on the commodity space, and Manisha joins in. And today, the focus is on cotton. Hi, Manisha. Morning.
Morning, Sumaria. I wish I could say that there is a lot of festival demand, but that really is not the reason why many of these commodities really are surging. The one major reason is that for cotton especially, you are looking at the October rains. For the standing crop, this doesn't really augur well. Well, yes, there is some mill buying as well, because we've seen cotton prices come off its all-time highs of around 51,000 to around 32,000 is where it's trading right now. The gain that you're seeing on your screens is because, one, we've seen erratic monsoon this time around. So even as the June-September monsoon ended with 6.5% of surplus rains, it is the October rains which really seem to be bothering the standing crop right now. From the latest IMD data, we understand that between 1st to 8th of October, it has been 43% excess rainfall that we've seen on standing crop, which is ready for harvest, and the arrivals have started coming in. So for the day today, even as the international cotton prices have declined by yet another 2%, the Indian cotton prices really seem to be doing well. If you look at the international cotton markets there, the US cotton acreage itself has seen quite a bit of an increase. Last year was around 11.2 million hectares. This time around is at around 30.79 million hectares. For the Indian markets, we still are trading 10 to 15% higher as compared to the international markets. The traders, the mills do tell us that the Diwali purchases, the B2B is almost done. They really are looking forward to the Christmas and the New Year textile demand at this point in time, which isn't very strong. But the only reason that you are seeing this divergence is that is the reason you have the international prices declining, but the Indian price is gaining up only because of the unseasonal monsoon rains that we are seeing extending within October.
All right, Manisha, thanks a lot for getting us a quick update on the cotton space. With that, we're going to head into a short break now. We're currently seeing around a 190-point cut on the Nifty. So let's take a break and come back. When we return, we'll talk about the market technicals with Kush Bora. Stay tuned for that.
Welcome back. Let's address some of the big movers today. Tata Motors is the top Nifty loser after second quarter JLR sales fell by 5% on a year-on-year basis. These are the retail sales numbers. Sonia is standing by to tell us more. Sonia?
Well, thanks a lot for that. As you rightly pointed out, Tata Motors is the biggest Nifty loser today after the Q2 JLR sales failed to impress the street. In fact, the company said that it is because of supply-side shortages, the semiconductor shortages, that the numbers were weak. But even if you look at the trend over the last many quarters, JLR managed to sell just 88,121 units, which is a fall of 4.9% year-on-year. But on an average, it would have done about 90,000 to 1.2 lakhs 3-4 quarters ago. So compared to its own average as well, the numbers have come down quite a bit. And this at a time when a lot of other automakers are seeing a revival in sales. So that's where the disappointment comes through. If you look at the breakup, Jaguar sales are actually down almost double digits, down 9.9% year-on-year. And Land Rover sales are down by about 3.6%. In fact, JP Morgan put out a note this morning where they downgraded Tata Motors from an overweight to a neutral. They say that because of the weakness in sales, it also delays the deleveraging timeline, and the company, may find it challenging to meet their own guidance that they had laid out of deleveraging. The miss, though, is driven by supply chain constraints. The wholesales have disappointed, while the retail sales are slightly better than what the street was estimating. Hence, the stock is under pressure. We had a chance to speak to a lot of auto ancillary players that supply to Jaguar Land Rover, like Motherson Sumi, for example, and they said that the China market is still under quite a bit of pressure because of the COVID challenges there, and that seems to be the problem pocket for Tata Motors. Back to you.
All right, Sonia, thanks a lot for getting us all of those details on Tata Motors. That is the top loser on the Nifty, almost 4% lower. But Sonia, also stay on because Atul Auto is surging in trade. It's up around 8% after the company announces the preferential issue of warrants, and veteran investor Vijay Kedia is investing. So tell us more about that.
Oh, absolutely. And you know, this is very interesting because this is Vijay Kedia's re-entry into Atul Auto. It was his biggest success stock, multi-bagger stock way back in 2005. I'll tell you about that. But for now, here's the news. Veteran investor Vijay Kedia will invest in Atul Auto through a preferential issue of warrants. Now, the total warrants issued are to the tune of 115 crores, out of which Vijay Kedia will invest a little over 100 crores. A total 58 lakh warrants have been issued, out of which 50 lakhs will be issued to Vijay Kedia. And the shareholding of Vijay Kedia will increase to 18.2% post-conversion to equity. Now, why is he interested in this company? Let's not forget, Atul Auto is a three-wheeler manufacturing company. They're into passenger as well as, commercial carriers. And basically, they manufacture rickshaws. They're into e-rickshaws as well. And if you look at the sales performance, the last 2 years were a bit challenging for Atul Auto. But this fiscal, things have improved quite a bit. So if you look at it year to date, April to September, the sales are up by 78.6% year on year. In September itself, the sales have gone up a little over 20% on a year-on-year basis. So the business is picking up. Now coming to the interesting part, Vijay Kedia, as we know, is a well-known value investor. He has over 30 years of experience in the stock market. Atul Auto was one of Vijay Kedia's biggest multi-baggers in the past. So way back in 2005, he invested in Atul Auto at a price of 9 rupees. The stock in the subsequent 9 years went up in excess of 5,000%. So that was the big multi-bagger idea. Of course, then the stock fell a lot from there, and now his reinvestment just tells you about the potential perhaps that he sees in the commercial vehicle business, the three-wheeler space, picking up quite a bit. Back to you.
Sonia, thanks very much for highlighting that. Let's also invite Kush Bora of kushbora.com now for a quick tech check on the market. Hi, Kush. Thanks very much for joining in. We're off of the morning lows, but still trending significantly in the red. How are things looking to shape up from here on the index level, and what stocks are you looking to pick?
Sure. First up, Samira, thank you for having me on the show. I would say the markets are actually on cue right now because, the last time I was, on air here, I said 17,500 and 17,400 is where we had a very significant call base. In fact, that call base was double of what the 17,000 put base was. So that was indicating that the markets have formed an intermediate, a near-term top. Now, the question was, whether we'll stay at 17,300 zones or 17,000 or 17,100 is where we'll slide to. And, we know the answer now. The comforting factor is, in fact, there are two of them. First, that the 17,000 put now has a very significant base, not only in the weekly expiry, but also the monthly expiry. So we'll probably hold on to those levels unless something, completely unforeseen comes our way from the global front. And also, the second point is that VIX, despite today's fall and despite this being a very heavy event-driven week, the VIX is not beyond 20 levels just now. So somewhere I think the bottom is also there around the 1700 levels, maybe 900 and 17,000 zones. So I would say trade the range for now on the indices, which is 17,000 and 17,300. Buying closer to support and selling closer to the resistance zones. A similar indication on Bank Nifty as well. Despite the FII selling that we saw on Friday, the private bank index sort of held on and in fact closed in the green. So that is suggesting some buying interest in Bank Nifty. So as long as 38,500 levels and 38,000 these zones are held, we should be in a comfortable situation as long as the Bank Nifty is concerned. And 39,800, 40,000 zones are where we'll look at selling the Bank Nifty, because that's where the resistance is placed.
All right, Kush, that is on the index level.
Could drive a decline in, where stock prices are currently?
Yeah, we have been actually below consensus by around 4 to 5%, even when we saw last time. For last 2 quarters, there have been earning downgrades for us as well as consensus by around 6 to 7% in aggregate. We believe even this quarter you will see some earning downgrades. But yeah, I think Street started with around 16-17% earning growth at the start of the year to begin with, which they have brought down to, I think now consensus is around 13. We are around 8. So we are still 5% below for the year. And we believe, you will probably see another couple of percentage points earning downgrades at the end of this quarter. Because you have to keep in mind that, the way crude is now again back to, Brent is again back to $97, $98. And this is on currency of 82, 83. So which means that second half also margin pressures will not go away that easily for some of the commodity consuming sectors. So I think that could drive a bit of downgrades for some of the sectors for the entire year.
Hi, Varun. Morning. So where might the bulk of the disappointments come from this earnings season? What are the sectors?
So in terms of sectors, one is say FMCG to an extent where the demand side is not very strong. So I think cost pressures are pretty much everywhere, be it IT, be it cement, be it FMCG, FMCG, even to some extent for some of the infrastructure sort of plays. There are cost pressures, but it's a case of where at least the demand is strong, you at least get the top line growth. But certain sectors like FMCG, where demand is also not very strong, will have a tough quarter. Cement, anyways, is a seasonally strong, seasonally weak quarter, the monsoon quarter, so they will have demand side issues as well as high cost inventory of raw materials getting consumed. So you will see a sequential margin decline. Capital goods and autos will be slightly better because the metal prices have come off a bit more sustainably than oil and gas prices, and therefore I think out there the margin picture will look sequentially better from this quarter itself. I think financials is probably the only sector where we don't see any pressures either on the credit growth side or on the NPA side. So that is probably going to be the the key driver of overall Nifty earnings in this quarter. IT again, while demand would be reasonable, but cost pressures would still sustain in this quarter. And demand outlook, I think for FY24 is a bigger question which investors are asking for IT compared to FY23. So I think a lot of sectors are still not, I would say, looking like very they don't have a very clear view on how earnings will progress over 6 to 9 months.
Varun, thank you very much for that. But this time in the IT earnings, the positioning is such that the weight of expectations is very low, right? Everyone's expecting a weak quarter. So even if the IT companies manage to meet expectations and say that things are okay, demand is still very much intact, I think it should be okay from a street point of view, just given the way positioning is. Everyone's anyway underweight. The FIs have been cutting down their expectation. So I'm saying in terms of positioning, it works in favor of the IT companies, and IT has actually outperformed last week as well. I think the IT index was up close to about 3% and today as well. Look at the recovery that you are seeing in intraday names. TCS is actually in the green. So positioning works, for the IT stocks this earnings season.
It will definitely be interesting to see how the IT companies fare now, because this entire week is going to be packed with the bigger ones. So we don't have too much longer to wait before TCS also does post its earnings. We're going to get into a short break now, but before we do that, here's some great news for investors. You can now track US market action real time on Money Control. So just log on to the Money Control website or app and stay informed about all that matters in global markets.
Welcome back. All eyes will be on TCS today. Numbers typically come out closer to 5:30 p.m. is the press conference. And let's quickly tell you what the street is expecting. Well, the street is expecting perhaps that there could be a beat. Look at the way the stock has recovered. But in terms of numbers, these are the consensus expectation. Dollar revenue growth, 1.3%. Constant currency revenue growth, 3.4%. Similar to the growth that it had in Q1, which was 3.5%. So top line growth is expected to be strong because the top line growth is a function of the deals won in the prior quarter. So across the board, Q2 revenue growth is expected to be fairly intact. On margins, margins are expected to bounce back by 70 basis points, improve by 70 basis points, because Q1 margins were hurt due to wage hikes. So there is no wage hike impact. So that explains the quarter-on-quarter margin jump. And profits, according to our poll, should come in at about 10,250 crore. In terms of commentary, TCS never gives you, it never gives you a guidance. But in terms of numbers, this time they did say that they're hopeful Q4 margins will improve to 25%. So do they continue to maintain that? Secondly, their exposure to UK and Europe is higher at close to about 35%, 30% of the overall revenues. Thirdly, the two lead indicators of demand, which gives you a sense of what the next growth is going to be is deal wins, and the other one is hiring. And both deal wins and hiring were a bit muted in the prior quarter. So those are the two numbers apart, that the street will be tracking very closely. While the near-term revenue growth outlook for the sector remains strong, we will watch for commentary which gives you a sense of how FY24 is going to be in terms of deal wins, in terms of revenue growth, in terms of a recovery in margins. And there have been a lot of reports on the supply side that not TCS, but how other IT companies and large IT companies have delayed the onboarding of freshers. So they're not saying that we will not hire you, but instead of say joining in September, they're saying come join us in December. Yeah. Variable pay has been lower than what the company, these employees enjoyed last year. So there have been a lot of reports surrounding freshers, hiring, promotions, wage hikes, bonus. Yeah. So supply side commentary is going to be very crucial.
All right, so we don't have too much longer before we do get TCS's earnings, and we trust Rima to break down all of those numbers. Remember, you can also catch the TCS MD and CEO, Mr. Rajesh Gopinathan, address the media at the earnings press conference scheduled for 5:30 p.m. today. All right, with that, we're going to wind down on this edition of Trading Hour. The market has recovered a little bit. It's now a 130-point cuts. We've seen around a 70-point recovery in the past 30 minutes or so, around 0.8% lower on the Nifty. The Nifty Bank Index is around 0.4% lower, so there's been a significant recovery there as well. And the mid-cap index is still looking a little bit weak, around 300 points on the mid-cap index. Thanks a lot for tuning into Trading Hour. Halftime report is up next.